Hello my friends, Chill Guy here. Today is Friday, February 6th, 2026. And I need you to stay with me for the next few minutes because what just happened in silver is the kind of move that changes careers, breaks weak hands, and turns quiet mining stocks into absolute rockets. Last week, right into the close, silver didn't just dip, it dropped hard. A brutal single-day wipeout that felt like the floor vanished. And gold didn't escape either, it slid too. Then almost immediately, silver snapped back and started climbing again. If you blinked, you missed the pivot. If you panicked, you probably sold the bottom. And if you're still watching right now, you're already ahead of most people. Now, quick favor before we go deeper. My analytics keep yelling the same thing. A huge chunk of you watch every video and still haven't subscribed. If you value this kind of straight-shooting market breakdown, hit subscribe right now and drop a quick comment. Even Chill Guy is enough. It tells the algorithm you're here and it helps push back against the copycat wave flooding this space. All right, let's rewind the tape. Silver was on an insane run. Not a normal bull move, an overheated sprint. Less than a year ago, silver was sitting down in the mid-20s. Then it ripped. It ripped so fast even the hardcore bulls started looking at each other like, is this real? And it didn't stop at 40 or 60 or 80. It ran into triple digits and made the whole world pay attention. But here's the thing. When a market runs that hot for that long, it creates pressure. And pressure doesn't disappear, it releases. Sometimes gently, sometimes violently. What we saw on that Friday looked violent. Silver took one of the sharpest single-day hits anyone can remember. And yes, it was ugly. But ugly doesn't automatically mean the story is over. Sometimes ugly is the market clearing out leverage so the next leg can start. So what caused it? First, the obvious one. The run was stretched. When prices climb relentlessly, a lot of people pile in late. They don't buy because they understand fundamentals. They buy because they see green candles, and they want in. That's where leverage starts stacking. Margin money, fast money, momentum money. And when fast money gets nervous, it all tries to exit through the same tiny door at the exact same time. Second, the mechanics. When exchanges raise margin requirements, it's like turning up gravity. Traders who were comfortable yesterday suddenly need more collateral today. Some can add, many can't, so they sell. Not because they want to, because they have to. Third, the macro vibe. When messaging shifts more strong dollar and more hawkish, risk assets wobble. And silver, as powerful as it can be on the upside, is famous for exaggerating moves on the downside. It's like a sports car. Incredible on a clear road, terrifying on black ice. Now, there's another layer people keep asking about, and we should address it carefully. But honestly, a lot of longtime silver watchers believe the paper market plays games. They believe the system is naturally hostile to precious metals because metals expose the weakness of fiat. And whether you agree with that fully or roll your eyes at it, here's what matters. Silver has a history of strange behavior. And yes, it was ugly. But ugly doesn't automatically mean the story is over. Sometimes ugly is the market clearing out leverage so the next leg can start. So what caused it? First, the obvious one. The run was stretched. When prices climb relentlessly, a lot of people pile in late. They don't buy because they understand fundamentals. They buy because they see green candles and they want in. That's where leverage starts stacking. Margin money, fast money, momentum money. And when fast money gets nervous, it all tries to exit through the same tiny door at the exact same time. Second, the mechanics. When exchanges raise margin requirements, it's like turning up gravity. Traders who were comfortable yesterday suddenly need more collateral today. Some can add, many can't, so they sell. Not because they want to, because they have to. Third, the macro vibe. When messaging shifts more strong dollar and more hawkish, risk assets wobble. And silver, as powerful as it can be on the upside, is famous for exaggerating moves on the downside. It's like a sports car, incredible on a clear road, terrifying on black ice. Now, there's another layer people keep asking about, and we should address it carefully, but honestly, a lot of longtime silver watchers believe the paper market plays games. They believe the system is naturally hostile to precious metals because metals expose the weakness of fiat. And whether you agree with that fully or roll your eyes at it, here's what matters. Silver has a history of strange behavior. On that same day, there were reports silver moved far beyond the so-called intraday speed limits that are supposed to trigger pauses. If that's true, it raises a simple question. Was this purely a normal correction? Just leverage getting flushed out? Or did someone lean on the market when liquidity was thin? I want you to answer in the comments. Do you think that drop was mostly technical and forced selling, or do you believe there was intentional pressure in the paper market? Be respectful, but be real. I read the comments. Now, here's the part that keeps people hooked to silver like it's a mystery novel. Even after the punch, the demand story doesn't vanish. Silver isn't just a shiny metal trade. It's an industrial necessity. It's a critical input, and the world is using more of it year after year. Solar, electronics, cars, defense, medical, all of it. And the more complex the world gets, the more silver gets quietly consumed in the background while most people aren't watching. That's why I keep coming back to one brutal reality. Supply doesn't ramp overnight. Mines take years to build. Permits take time. Capital takes time. Skilled labor takes time. And when the pipeline is thin, you don't just snap your fingers and create new metal. So when silver runs, it can run farther than anyone expects. Then it can punish anyone who chased late. Then it can run again once the weak hands are gone. That's why I've been saying, don't confuse volatility with death. Volatility is the admission price. Now, let's talk about the question everyone is whispering right now. Do we see triple-digit silver again this year? A lot of people used to think triple digits was fantasy. Then it happened faster than expected. And now the market is doing what it always does after a shock. It tries to convince you it was a fluke. It tries to convince you the door's closed. But if structural demand is real, if industrial users are bidding under the market, and if supply is constrained, you don't need magic for silver to revisit those levels. You need time. You need persistence. You need buyers who can't substitute silver with something else. Here's an underrated point. Industrial buyers do not care about your emotions. They care about continuity. If a factory needs silver, it needs silver. Shutting down a production line costs more than paying an extra few dollars per ounce. That creates a floor behavior most people underestimate until it's too late. Now, I'm going to pivot to the part that can turn this story from interesting to life-changing. And it has nothing to do with the metal price itself. It's the mining equities. This is where a lot of investors mess up. They stare at the silver chart. They celebrate the rip. They complain about the pullback. And they never do the math on what higher silver prices do to miner cash flow. So let's do the math in plain English. Imagine a miner with an all-in cost around $20 per ounce. When silver was $25, that miner had about $5 margin per ounce. If they produce 10 million ounces, that's roughly $50 million operating margin. Solid, but not world-changing. Now take silver to 85. That same miner isn't making $50 million anymore. They're making something like $650 million in margin if costs stay stable. That's not a small improvement. That's a different universe. That's why miners can go ballistic. Even if silver doesn't keep climbing, the price just needs to stay elevated long enough for the financial statements to prove what's already happening. And here's the trap. Wall Street lives in the rearview mirror. Analysts model off old assumptions. They anchor to last year. They anchor to last quarter. They anchor to a normal silver price that may no longer exist. So, miners can stay mispriced longer than you'd expect, until earnings season forces reality onto the table. The setup is simple but powerful. If metal has moved and equities haven't fully reflected it yet, the catch-up can be violent. Now, I want to slow down and be responsible for a second. This is not me telling you to buy anything. This is me telling you what to watch. Watch the next wave of earnings. Watch guidance. Watch cost control. Watch free cash flow. Watch expansion plans. The market will reprick the winners. But be careful. Not every company with silver in the name is a real silver business. Some are explorers with no production. Some are lifestyle companies. Some are dilution machines. In a hot cycle, they all talk big. In a cold cycle, only the real operators survive. So if you're going to play miners, focus on quality and survival. Real assets, real teams, real cash flow, or a clear path to it. Now, let me add a cliffhanger most people ignore. The biggest move in miners often doesn't come when silver is making headlines. It comes when the crowd thinks the move is already done. And then earnings show how wrong the crowd is. That's why I'm telling you, don't fall asleep. Now back to the market. Gold deserves a quick mention because gold is the big brother here. When gold moves, the whole precious complex gets permission to reprick. And there's something happening at the street level you won't always see in the chart. When people line up outside bullion shops, that's not a meme. That's a signal. When buyers show up early, get turned away, and come back again, that's not top behavior in an under-owned asset. That's recognition behavior. That's the public slowly realizing paper promises are not the same thing as hard assets. And yes, there's a regional aspect. In much of Asia, precious metals have cultural muscle memory. In parts of the West, people got distracted by stocks, real estate, and easy money. But when cracks appear, people come back to the old anchors. The tailwind for gold and silver isn't one headline. It's accumulating stress. Debt, deficits, policy uncertainty, geopolitical tension, and the political reflex to print, cut, and patch problems instead of solving them. When the next recession scare hits, what do policymakers usually do? They reach for the same tools: lower rates, stimulus, liquidity. Those tools weaken purchasing power over time. And that's why gold and silver keep returning as insurance. Now, I want to bring this into a practical storyline without naming names or turning it into a commercial. There's a company I've been tracking that controls a major high-grade district in a stable jurisdiction. They've got past producers, a big land package, aggressive drilling, and they're in the middle of combining with another company that already has operating cash flow plus growth projects in the pipeline. Why does that matter? Because scale changes everything. Bigger company attracts bigger money. Bigger money brings liquidity. Liquidity brings valuation re-rating. And in a bull market, re-rating can move faster than the drill bit. There's a shareholder vote scheduled for mid-March. If it passes, the combined company could be effectively complete by late March. Not a promise, just a catalyst clock. Markets love clocks. The idea is to build a platform. Production plus development plus exploration. Not one project, multiple. And with that mix, growth can be funded internally instead of endlessly begging the market through dilution. On the exploration side, they recently released results from a vein corridor showing extensions, better continuity, and hints 2 major zones might connect. That sounds technical, but translation is simple. The mineralized footprint may be bigger than the market priced in. And in a silver bull cycle, bigger than expected is the phrase that creates the next wave of headlines. They've also got another target a few kilometers away that's more gold-heavy with results expected soon. Meanwhile, the partner company is drilling a high-grade gold system at a past producer with results also expected soon. So you've got a near-term sequence. Drilling, vote, closing, earnings, more drilling. That's how resource stocks really move, not a straight line in bursts. And the burst is what people remember. But here's the uncomfortable truth. It's a rocky ride. If you can't handle red days, this sector will chew you up. It's volatile by nature. 15% up days, 12% down days. And if you're emotional, you become exit liquidity for people who aren't. So the real edge isn't predicting every tick. The real edge is understanding the cycle and staying patient. Now, let me speak directly to the long-timers. A lot of you lived through a decade where precious metals felt dead. Rallies failed, miners disappointed, hype came and went. That experience trains you to expect pain. So when you see a massive down day, your brain screams, "Here we go again." But this cycle isn't the old cycle. When corrections get bought quickly, it signals something. There is real demand waiting. It signals the market is in a different stage. In that stage, pullbacks don't linger forever. They get absorbed. Then price reaches for higher ground again. So think like a strategist, not a gambler. Where is the demand? Where is supply? Where is leverage? Where is fear? Where is forced selling? Because forced selling is the gift. That's what creates mispricing. Now, second engagement question. If you had to choose one, would you rather own physical metal in your hand or a basket of quality miners for leverage? And why? Drop your answer in the comments. I want to see how this community thinks. And if any of you are already winning in this space, maybe you caught the move early. Maybe you turned a small position into something meaningful. Share your story in the comments. Not to flex, to teach. People need to see what's possible and how you approached it so the community stays strong. And yes, by the time you're watching this, there's already a members-only video live. It ties together the latest moves, key levels, and deeper context in one place. If you want that full package and you want to support the channel directly, you can join and watch it. That also shows me who's really locked in. Now, let me close this out with a clean summary because I don't want you leaving with noise. I want you leaving with clarity. 1. That sharp silver correction was historic in speed, but it came after a historic run. That context matters. 2. Stretching, margin mechanics, and macro tone can combine into a waterfall move. That doesn't automatically end a bull market. Often, it resets it. 3. The manipulation debate exists for a reason, but even if you ignore it completely, structural demand is still the backbone. 4. Miners are leverage, and leverage is math, not feelings. When the gap between price and cost widens, cash flow explodes, and markets eventually reprick cash flow. 5. The biggest opportunity often appears when the crowd is confused, right after the punch, before the next leg looks obvious. So here's what I want you to do in this order. Subscribe. It's one click. If you want the full premium recap, check the members-only video already live and consider joining. Then comment "Chill Guy" plus your answers. Because comments are fuel that tells the algorithm this is worth pushing. And let me be crystal clear. I'm not here to entertain you with drama. I'm here to keep you from making the 2 classic mistakes people make in silver. Mistake 1, chasing euphoria. Mistake 2, abandoning the story. The second volatility shows up. Both mistakes cost money. Both mistakes are avoidable, and both mistakes are happening right now. When that Friday sell-off hit, you could feel it. Screens went red. Charts went vertical down. Social media turned into a panic room. Some screamed manipulation. Others screamed bubble. Most people did the worst thing possible, reacted without a plan. That's why I'm slowing this down and walking you through it like adults. Because this is how you build an edge in a market that eats the emotional. Here's a quick mental exercise. Imagine you're a manufacturer who needs silver every single day. You're not a trader. You don't care about bragging rights. You care about delivery schedules, contracts, and keeping machines running. Price goes parabolic, collapses in a day, then starts rebounding. What do? You don't rage quit the metal. You secure supply. You lock relationships. You make sure you're not at the back of the line when everyone wakes up. That's the quiet force under the chart most people underestimate, and it connects to something not talked about enough. Silver has multiple markets inside one market. There's the paper market where price updates every second. There's the futures market where leverage lives. There's the physical market where people want real coins and bars. And there's the industrial market where silver gets consumed and never comes back. These layers don't always move together. Sometimes the chart says one thing while the street says something else. And the gap between those realities is where the opportunity and danger lives. If you've ever walked into a dealer during a fast move, you know exactly what I mean. One shop quotes you something that feels cheap because they're overloaded. Another quotes something insane because they're sold out. That spread is information. It tells you where the stress is. And during wild weeks, that stress becomes the story behind the story. Now, you might be asking, are we at the end? I get it. A 26% drop in one day feels like the end of the world. But look at the context. The move up before it was extraordinary. When a market climbs for months, it builds a ladder. Corrections kick people off that ladder. Then, if the demand is real, the ladder gets rebuilt, often higher. That's why I like thinking in stages. Stage 1, disbelief. Only early contrarians care. Everyone else mocks them. Stage 2, wall of worry. Trend is up, but fear spikes and corrections shake people out. This is where most quit, right before the biggest move. Stage 3, mania. That's when your barber asks you about silver and your cousin starts a silver group chat. Stage 3 is fun. It's also where discipline matters most. Right now, based on the speed of the drop and the speed of the rebound, it looks like we're living in stage 2. Corrections get bought, fear spikes, bids appear. That's why the next few weeks matter. They'll tell us if this bounce is a dead cat bounce or the start of the next push. And here's the cliffhanger. If it's the next push, miners could move faster than silver itself. Because many miners are not priced, like silver is $85. Their price like silver is $35 or $40 because models lag and institutions move slow. They wait for confirmation. They wait for earnings. They wait for guidance. They wait for the CFO to say the quiet part out loud. Yes, margins expanded. Yes, cash grew. Yes, we can fund growth without dilution. When that confirmation hits, it can trigger three things at once. 1. Analysts raise targets. 2. Funds that only buy profitable companies start buying. 3. ETFs and indexes increase exposure as market caps grow. Let me make it even more concrete. Assume silver doesn't go straight back to 115. Assume it stays between $70 and $90 for months. That range would still be a dream environment for efficient producers. Costs don't double overnight, so margins stay wide. Wide margins create cash. Cash creates options. Paying down debt, buying back shares, restarting projects, launching dividends, making acquisitions. In bull cycles, the strong eat the weak. Assets get consolidated, and the market often rewards the consolidators because scale reduces risk. So, even if silver goes sideways, miners can still climb because the market is repricing the future, not the past. Now here's the warning label. Leverage cuts both ways. Explorers can rip 30% on a drill hole and drop 30% on a financing. They can dilute you, miss targets, hit delays, burn cash, while the market loses interest. That's why I repeat, quality like a broken record, strong balance sheet, enough cash, competent team, clear strategy, stable jurisdiction, and pay attention to share count. If a company doubles its shares every year, you can be right on silver and still lose because you got diluted into dust. Now, I want to circle back to that platform merger storyline because it connects directly to catalysts. Mergers matter in this sector because investors love a clean story. A single project story can get wrecked by one permit delay. A platform story spreads risk and attracts bigger money. Bigger money needs liquidity and scale. That platform mix, one producer, one near producer, plus development and exploration, creates a pipeline. Pipelines keep attention. Attention supports valuation. And calendar catalysts, like a vote, create anticipation. Anticipation creates positioning. Positioning creates the squeeze when news lands better than expected. So, here's what I'm watching into the heart of 2026. Quarterly earnings, cash flow that reflects the new price regime. Cost guidance. If costs stay controlled, margins explode. Exploration updates. Bigger footprints change valuations per share. Corporate actions, mergers, asset sales, joint ventures, buybacks, macro signals, rates, currency pressure, liquidity. Stack enough triggers and the trend feeds itself. Now, two quick community things because this isn't just me talking at you. One, if you've had success, silver, miners, business, freelancing, share one lesson in the comments. One simple lesson. It might save someone else from a costly mistake. 2. If you're new, ask your question in the comments. No shame in learning. The shame is pretending you know everything and getting wrecked. All right, back to silver. Zoom out and the real battle isn't does silver move $3 this week? The real battle is whether the world is shifting into a multi-year regime where hard assets reprick against paper. If that's the regime, silver isn't a one-trade story. It's a cycle. And cycles don't resolve in a week. They play out through fear and greed, pullbacks and breakouts, rotation from metal to equities to developers to explorers and back again. That's why I want you thinking ahead. If silver revisits triple digits, miners don't just rise, they get re-rated. Some will trade at valuations that look ridiculous compared to today. Not because the market became rational, because the market became urgent. Urgency makes people pay any price for exposure, and the winners are the ones positioned before urgency arrives. So here's my final cliffhanger. Hold on to it. The next surprise won't be silver printing a new high. The next surprise will be how fast equities reprick once earnings hit, and the cash flow becomes impossible to ignore. If you want to be on the right side of that, you don't need the exact day. You need to stay engaged, stay educated, and stay calm when the market tries to shake you out. And that brings me to the final ask. If you want this anti-copycat push to win, I need 3 simple actions. Subscribe, comment, and share. That's it. Those 3 things make it harder for low-effort copycats to win and easier for original work to rise. All right, my friends, take a breath. zoom out, respect volatility, and I'll catch you in the next update inside the WhatsApp channel, inside the members area, and right here on YouTube.